Hello, this is Julius from Basic Financials. This video is going to be a brief description of the Enterprise Investment Scheme. I had a comment from somebody a while ago actually about the Enterprise Investment Scheme and maybe doing a video about it. It's quite complicated legislation, but that shouldn't stop anyone doing it. Now, you could have this video from two sides really. I'll talk a little bit about both sides. You've got it from the company's point of view, and you've also got it from the investor's point of view. If I start with the investor's point of view, then that's probably what the person was referring to who asked for the video, and would be of most use to the people watching this, I expect. Now, the Enterprise Investment Scheme, it's for companies or for people, individuals investing in company shares. Now that's normally private companies, private limited companies with sort of family owned often, not always family owned, but and they tend to be smaller companies. But when I say small, that could mean anything, couldn't it? It's really with assets of less than about 5 million and employees of less than 250. When I say assets, that's like total assets before taking off liabilities. So it's can be fairly large companies. It depends on what perspective you're looking at. Nothing like BT, but a lot bigger than some very small companies. So an individual investing in these types of companies, the first thing to say is they are risky. You might lose everything. And that's why HMRC or the government are trying to incentivize people to invest in these companies, to give them some money, because they want to encourage growth and expanding in innovation really. So the companies don't have to be particularly they don't have to be innovative. All they really need to be is trading companies. So it could be a whole number of trades. There are some that are excluded, but you'd need to go into the detail of the legislation. But basically, they just need to be trading companies, and the money has to be used to grow, expand, and develop the company. Now, the tax reliefs. You can claim when you invest in the shares of such a company, EIS shares, you can claim 30% tax relief. So that's assuming that you've got that amount of tax that you've paid in that year. So in the year that you buy those shares, you can claim a tax break of 30% of what you invest. So if you pay £100,000 for EIS shares, in that tax year, you can claim £30,000 off your tax bill, assuming that you've had a tax bill of at least £30,000. You could also elect to claim it back to a previous year if you wanted to. So if you haven't got a tax bill of £30,000 in this tax year, but you did in the previous year, you could claim it as if you'd bought it in the previous tax year. You can actually invest quite a lot into EIS shares. You could invest up to £1 million a year in EIS shares. There is a maximum overall. I think it's 5 million that you can invest. I think that's 5 million, but it's worth checking that. But £1 million each year. But let's say we'll work with figures of 100,000 as a more realistic investment. Now, that income tax break isn't the only one. The other thing is, so long as you hold those shares, to get that tax relief, you have to hold those shares for 3 years. So if you sell those shares or get rid of them in some other way before the 3 years, then that tax relief would be clawed back by HMRC. So that's important. You need to hold those shares for 3 years. Now the other tax break is that when you do sell those shares, if they have grown in value, then the capital gain would be exempt from capital gains tax. So that's quite a good relief, because normally you would pay capital gains tax of 10% or 20% depending on your tax rate, but you would pay nothing. So that's quite a good break. There is another thing with capital gains, and that's if you've had a capital gain in a previous year. It can be up to 3 years beforehand or 1 year after if you've made a capital gain, and then you buy EIS shares. You can actually defer that gain that you already made against, or that you're going to make, against the cost of the shares. And I won't try and explain that, but it's potentially a useful relief, because you might have paid capital gains tax. Then you can say that you want to set it off against that the shares you've just bought, and then you get a tax refund for the capital gains tax you've already paid. When you do sell those shares, that capital gain will realise, and then you would pay the tax on it again. That's the gain that you previously realised, not the gain on those shares, because as I said, the gain on the actual EIS shares would be exempt if you've held them for 3 years. Another quite useful tax relief is if for some reason you make a loss on your investment, you can claim that loss as an income tax deduction. Except you've got to reduce the original cost by the amount of the tax relief you had. So, for example, let's say you paid £100,000 for EIS shares and you got £30,000 tax relief against your income. So the actual cost of those shares is £70,000. Now, if you lost everything on your shares, let's say totally wiped out, then you've basically lost that £70,000. You've had £100,000 less than £30,000 tax relief. So £100,000 it becomes £70,000 straight away, and then you can claim loss relief of £70,000 against your income. So if, for example, you were an additional rate taxpayer, which is 45%, then you could potentially get another 45% tax relief on that £70,000 that's left. Which basically means that you've limited if you're an additional rate taxpayer, you've limited your £100,000 investment risk to a maximum loss of, I think it's £38,500, because of the original £30,000 tax relief and the tax relief on the loss. So that's quite a good, well, I mean, it sounds very, very good, but obviously the risk is that you do actually lose that £38,500 overall. But sometimes these risky companies can pay off, and you can then get your gains without paying any tax on it, and you've had tax relief on the investment. So it's something worth thinking about, but it is risky. There are 2 ways you can actually invest in these EIS shares. You can do it directly with the company, or you can do it through trusts, through funds, basically a fund, whether you have a fund manager that invests in EIS shares. So you put your money into the fund, and then they will invest on your behalf and find the shares. That might spread your risk a little bit, probably costs a little bit more in fund fees, but that's a good way of spreading things, and there may be a simpler way of doing things as well. Now that's from the individual's point of view. Now, just a brief description of the company's point of view. If you've got your own company and you want to attract investors from outside, then you might want to do EIS shares. When you do that, you have to apply and submit a form to HMRC, and assuming that they agree that everything's in place. I'm not going to go into the detailed rules of what your company has to do, because it's quite complicated. There's lots online about it, either on the .gov website or there are other places as well. But once you've applied for the EIS status, then HMRC will give you a certificate to say that you're okay for it. And when you issue your shares, you have I think it's called an EIS 3 certificate that goes with them, and that will entitle the investor to claim their tax relief. You have to make sure that you comply with the rules of the scheme through the time, so that, or at least for 3 years, so that the investor doesn't lose their tax breaks. That wouldn't be too good. But it is a good way of attracting investment money. So I think I'll leave it at that. It's quite a complex subject, and I've just covered the basics of it really, but it gives you an idea. And I hope that helps, and I'll see you again in the future for another video. If you could like and subscribe as usual, please. Thanks for listening.